Equity Market Update, June 2022. Indian equity markets fell during June 2022, with Nifty 50 and S&P BSE Sensex declining by approximately 5% compared to a month ago. The growing concerns of global growth slowdown, tightening by global central banks, elevated inflation, fall in commodity prices, sustained selling by FPIs, etc., were the key drivers of market movements for the month. Large caps outperformed mid caps and small caps during the month. Sectoral performance was weak, and most major indices, except auto, delivered negative month-on-month returns. Metal, IT, and banking sector were the key underperforming sectors. Most major global equity indices, except China and Hong Kong, also ended the month in negative. FPI sold equities worth approximately $6.4 billion in June 2022, following net selling of $5.2 billion in May 2022. On a cumulative basis, FPIs have sold equity aggregating $28.4 billion in H1 CY22, compared to being net buyers of approximately $8.3 billion during the same period last year. FPI selling, to a certain extent, was balanced by strong buying by domestic mutual funds. Net inflows to mutual funds stood at approximately INR 27,600 crores in May 2022 and approximately INR 150,000 crores in 5MCY22. Outlook: as on 30th June 2022, Nifty 50 was trading approximately 16.8x FY24E price to earnings ratio. Though the valuation multiples have corrected from the peak, it remains high compared to its historical average. However, it should be viewed in context of steady economic recovery and corporate earnings outlook. Again, the ratio of India's market cap to GDP based on CY23 eGDP is approximately 85%. That is, in the range of 60 to 100% in which equity markets have traded during most of the last decade. The gap between 10-year GSEC and 1-year forward Nifty 50 earning yield has moderated from its peak, but still remains higher than its long-term average. Moreover, corporate earnings growth is likely to normalize from FY23 onwards. Thus, on an overall basis, markets appear to be reasonably valued. Post the recent correction, the valuations gap between the current valuation of many sectors have reduced compared to their long-term averages. However, many of the sector valuations on an aggregate basis still remain above its long-term averages. In view of the above, while markets hold promise over the medium to long term, one should moderate return expectations in the near term. Outlook for the market is likely to be driven by expected growth in nominal GDP and corporate earnings growth. We remain positive on the economy and equity markets over the medium to long term, on the back of favorable domestic growth outlook, steady corporate profitability, growth-oriented policies, etc., accelerated monetary tightening, sharp increase in US yields, elevated inflation and commodity prices, slowdown in China, FPI's outflows, etc., are key near-term risks. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.